Hi, it's Greg Watson here from the Investor Hub. I want to talk to you today about what's been happening lately in the interest rate market. There's been quite a lot of changes over the last 3 or 4 months, and we've seen 2 drops from the Reserve Bank to the cash rate. And what that's meant is that variable home loan rates and investment rates have dropped by around 0.45 to 0.5 to 0.6%. So what we've seen so far in the interest rate cycle, and what we've observed in the past, is that fixed rates always bottom before variable rates do. And what we have seen is we've actually seen a couple of ticks up in a couple of the fixed rates for some lenders. So we've seen 2 and 3 year rates rise for a couple of lenders, not by very much, but it's enough to suggest that we may have reached the bottom and we're starting to move back the other way. The Reserve Bank has indicated that there's going to be a long period of stability in interest rates, but it wouldn't be a surprise to see things tick up a bit at some point. So we have some fabulous fixed rates, of course, and variable rates are at all-time lows. So it's a really good time to be locking rates in. So I wanted to give you a bit of explanation around what drives fixed rates. People see the cash rate go down, but then see fixed rates go up sometimes, and there's a reason for that, because the cash rate does not drive what happens in the fixed rate market. There's what's called the bank bill swap rate, and that's what drives the cost of funds for banks at various time frames throughout the yield curve, and they price their fixed rate loans based on that, not based on the cash rate. So what we've seen is we've seen that curve turn around and go up again, and we're seeing fixed rates climbing as well. So I want you to have a look at this chart. On this chart, the blue line demonstrates the bank bill swap rate yield curve, and then the red line shows what interest rates are at the moment. At the moment, it's the end of May 2015. So the green line is the margin that the banks are making between the bank bill swap rate and their interest rate. So you'll see at 3 to 5 years, the margin for the banks has declined quite a bit. It's actually below 2% in a couple of areas there. But there really is a sweet spot for borrowers between 3 and 5 years. So you can actually lock in that interest rate. So there actually is a sweet spot for investors and homeowners in that 3 to 5 year bracket. And that's what I'm recommending to a lot of clients at the moment, is to be able to lock those rates in for a period of 3 to 5 years. You know what your cost of funds is going to be. And if you're an investor with rental returns are really going backwards in most areas. So you know you can lock in your rate of return on your property for a period of 3 to 5 years. So enabling that stability at this period of time seems to be a really key outcome for the way interest rates are placed at the moment. So if you want to have a conversation about the structure of your loans and looking to find your own sweet spot within that, give me a call on 1300 651 363 or email the Investor Hub at info@theinvestorhub.com.au. I'm Greg Watson from the Investor Hub. Talk to you soon. Bye for now.